I welcome the students of Business Team e-learning course Financial Accounting, Chapter 2. In this video we will cover the issues of building balance sheet based on a transactional analysis. So let's assume that there's a business called Jacob's Tennis and Golf Store, and a business owner, Harry Jacobs, is investing his first $50,000 in the business bank account. So let's see how it reflects the balance sheet accounts. So we first build a balance sheet equation, which is assets equals to liabilities plus owner's equity. So we apply some formatting in here. Let's center all this data in here, and let's add some bold for these headlines. Alright, let's assume that this first transaction is, let's label 1, and so how does it affect? We have cash of 50,000, and also we have Jacobs, the owner's capital, which is also 50,000. So in effect we have reached the balance. So let's apply some formatting for this number. So let's select this and then go to the format cells, and let's make it numbered, but there is no decimal places. So we apply this, and now it looks a bit better. So let's assume that Jacobs thinks he needs more money than this, so he goes for the bank and takes a loan of 20,000 with annual interest rate of 8%. But let's forget about interest for now. So let's see how it affects our balance sheet. So we have again increased cash by 20,000, and also we have a liability which will occur in a year's time, so we add it as a notes payable, again 20,000. So as you may see, we again have a balance. Let's save this file before moving on. So we save it as a Jacobs Tennis and Golf Store. So third transaction is Jacobs is thinking about renting an office space because he needs it to run his business. So it's the third transaction is renting an office space for 12,000. So first of all, of course, cash is affected by this transaction. So we have minus because cash is declining. So as you may see, the cash has declined already. So they should be balancing equation also with other item in the balance sheet. So important moment is that we have acquired the right to occupy this place. So it's also an asset that is affected. So we added another column in here. So we select this column and right click and then press insert. Let's adjust it a bit. So we can call it prepaid rent because it's paid in advance. So we actually pay for 2000, let's say 9, but we paid actually in a 1st of January, but we actually assume that it's for 1 year. So it's also 12,000, and as you may see, we have again a balance in this case. Important thing to remember here that assets are always recorded at their historical cost. So if we actually pay this in 12,000, we actually need to input it in 12,000, no matter what's the amount at the end of the year, because of the changes in inflation, for example. As Jacobs is involved in a sporting goods sales, he needs some inventory. So inventory is a merchandise acquired for resale to customers. In this case, it's a different kind of sporting equipment for tennis and golf in Jacobs' case. So let's assume that he's buying an inventory for the amount of 30,000 on account, meaning on a credit. So it's our fourth transaction. So we put another inventory is also asset, and we put it again in here, so it's an increase of 30,000. So another item that is affected in our equation will be accounts payable, as notes payable is not used in this kind of transactions. We use accounts payable, which is unwritten obligations that arise in the normal course of the business. So we add it in our liabilities column and accounts payable. Again, an increase of 30,000, and we have a balance. The last transaction that is involving in here is the purchase of equipment that the Jacobs needs to run his business. So this can be cash registers, display cases, and different things that have a life more than 1 year and will bring additional value. So let's input this transaction as number 5, and what's affecting in here is basically cash, because we buy it by cash and it's declining by 25,000. And the second item would be also in the asset side. It will be equipment, which will increase in 25,000 amount. So we have no change in assets, and we have again balance. Let's put it in a readable balance sheet format. In order to do that, let's work on a sheet number 2. So let's save this sheet as a, let's right click on it and rename it as a balance, as a transactions. And the second sheet we'll rename it as a balance sheet.